Welcome to the deep dive. Today, we're peering into, one of the most surprisingly complex sectors out there. It's essential, it's infrastructure heavy, sometimes politically charged, and yet most of us barely think about it. Waste
Well,
management.
it really is the ultimate sleeper giant, isn't it?
Yeah.
When people talk critical infrastructure, they think bridges, power grids, fiber optics, that
Right.
sort of thing.
The flashy stuff.
Exactly. But the system that handles, well, the physical leftovers of our entire economy, the waste that's absolutely non-negotiable, you can't offshore it.
Definitely can't skip a week without noticing.
Oh, absolutely not. Serious public health issues would pop up almost immediately. And the structure of the industry, its stability, it's, frankly, pretty phenomenal.
Okay, let's unpack this then. Jump right in. Our mission for this deep dive is really to decode this often overlooked infrastructure play. We're focusing on Republic Services, Inc., ticker RSG, the second biggest player in the U.S. environmental services space, vertically integrated and all that.
Yeah, and the goal here is to get way beyond just picturing the truck rolling down your street.
Yeah.
We need to understand why this industry's unique structure. It's basically an oligopoly gives companies like RSG such immense pricing power and financial stability.
And also trace how they're changing, right? Moving beyond just being seen as a, non-hazardous solid waste collector.
Precisely. They're actively positioning themselves now as a comprehensive environmental services leader. That's a really important shift.
That reframing seems critical. It's not just semantics. Moving from trash collector to environmental service leader signals a huge expansion in what they actually do, pushing into higher growth areas, higher margins, things like hazardous waste, even energy production.
Exactly. It's an essential service,
Yeah.
but it's moving up the value chain. Very interesting strategic move.
So the bedrock of Republic Services' strength, you mentioned vertical integration. We hear that term a lot with infrastructure. How does owning the whole life cycle of waste, soup to nuts, create this economic moat everyone talks about?
Right. So vertical integration here means they control the entire flow. They own the collection routes, the trucks picking up the bins. They own the transfer stations, which are crucial intermediate hubs.
Okay, pause there. Transfer stations, what exactly are they consolidating?
Good question. Think of the collection trucks running relatively short local routes. They fill up. Driving that truck, say, 50 miles to a landfill is super inefficient fuel, time, wear, and tear.
Makes sense.
So instead, they drive a short distance to a transfer station, they dump the waste, it gets compacted, maybe sorted a bit, and then loaded on a much larger, specialized long-haul trucks, or even rail cars for the efficient trip to the final disposal site.
Got it. So it's a logistics optimization step.
Exactly. And RSG owns those transfer stations, the processing centers for recycling, we'll get into those, and critically, the final destination, the disposal site, usually a landfill.
Owning every step means they capture the profit at each stage. No third parties taking a cut.
Precisely. They internalize all those potential profit margins, and it links directly to their geographic strategy, something they focus on called route density.
Route density. Maximizing pickups per mile driven.
That's the core idea. Waste management is fundamentally a local game. It's incredibly sensitive to distance, fuel costs, labor hours per pickup, truck maintenance. These are huge operational expenses.
So if RSG can saturate a local market, run really tight, dense routes.
They achieve massive economies of scale. Think about it. If you have 50 trucks operating efficiently in one city versus a competitor trying to start up with maybe 2 or 3 trucks spread thin.
The new guy can't compete on cost. Their routes are automatically less efficient.
Exactly. That local market dominance, built on route density and fueled by vertical integration, is the first layer of their competitive advantage. It's like running a really optimized local delivery network versus just, running random errands across town. Scale is profound here.
Okay, makes total sense. Now, let's look at the revenue streams. Collection is the biggest piece, but you mentioned it's not monolithic. It's got 3 distinct customer types. Can you walk us through that? How does it balance risk?
Yeah, it's helpful to think of these as different kinds of cash flow, each with its own character. First, you've got residential. This is the absolute bedrock.
The bins at the end of everyone's driveway.
Right. And it's typically covered by long-term municipal contracts. These are often annuity-like, sometimes even exclusive franchise agreements, where the local city or county says RSG is the only provider here.
Super stable, predictable revenue then, like a mortgage payment for the company almost.
That's a great way to put it. Very reliable, doesn't really swing much with the economy. Then you have commercial.
The dumpsters behind shops and offices.
Exactly. Services for retail, offices, small businesses. This segment is a bit more tied to general local business activity. If stores close, they lose a customer. But still pretty stable overall.
And the third leg, industrial. This is the one that moves with the economy more.
Definitely. Industrial is the most cyclical. This is serving manufacturers, construction sites, big infrastructure projects. Think large roll-off containers. When construction booms, industrial waste volume goes up. When it slows, like we've seen recently in some areas, volume drops.
So the stability of residential and commercial helps cushion those industrial swings.
Precisely. It's a balanced portfolio within their largest segment. Okay, so waste is collected, it goes maybe through a transfer station. Then what? Disposal is obviously key, owning landfills.
We'll definitely dig into landfills more. They sound crucial. But first, what about recycling? They have material recovery facilities, MRFs, but the sources really highlighted their investment in advanced polymer centers. What's that about?
Ah, yes. This signals a really significant strategic shift, moving up the value chain. Traditional recycling, especially single stream where everything's mixed,
Yeah.
it's often low margin.
Isn't it volatile, right? Depending on commodity prices for paper, plastic, metal.
Hugely volatile. So the polymer centers are different. They're investing heavily in sophisticated technology, not just sorting, but washing, purifying, to take recovered plastics and turn them into high-quality recycled plastic resins. Think RPEPI, RHDPE, stuff manufacturers actually want.
So instead of selling, say, a messy bale of mixed plastic scrap for pennies a pound.
They're producing a specification-grade industrial input, something that can genuinely substitute for virgin petroleum-based plastic.
And manufacturers need that for their own ESG goals, using recycled content.
Exactly. It commands a premium price, it aligns with customer sustainability targets, and crucially, it gives RSG a much more stable revenue stream from recycling, far less exposed to those wild swings in global scrap markets. This is a big deal strategically.
Okay, fascinating. And then there's the newest, highest growth area, environmental solutions.
Right. This is the segment they seriously bulked up with the big U.S. ecology acquisition back in 2022. This isn't household trash or cardboard boxes. This is much more specialized, higher margin stuff.
Like what specifically?
Think industrial cleaning services, specialized treatment for hazardous waste chemicals, contaminated soil, things like that. Managing regulated medical waste from hospitals. Complex chemical disposal. And they also offer 247 emergency response for spills or environmental incidents.
That sounds like a completely different business. Requires specialized permits, expertise.
It absolutely is.
Yep.
And that's why the acquisition was transformative. It instantly gave them the scale, the permits, the know-how, and the specialized facilities to compete seriously in this roughly $29 billion environmental solutions market.
Compared to the traditional solid waste and recycling market, which management sizes at around $78 billion.
Correct. So the total pie they're playing in is North America, roughly $107 billion annually.
Yeah.
But that $29 billion environmental solutions piece, that's where they see significant growth potential, often at better margins than just hauling municipal waste.
Yeah.
It's a classic diversification move into adjacent, higher return areas.
And underpinning all these different segments, collection, disposal, recycling, environmental solutions, is the strength of their contracts, right? You mentioned municipal ones are long-term.
Immense contractual stability across the board, really. A huge portion of their revenue is locked in through long-term agreements, sometimes 5, 7, even 10 years or more.
And the really crucial part is the pricing language baked into those deals.
Yes, this is key to their financial performance. Most contracts include mechanisms for annual price escalations, sometimes tied to inflation indexes, sometimes fixed percentages. This allows them to consistently offset their own cost, inflation labor, fuel, steel for bins, truck parts, you name it.
But it's more than just offsetting costs, isn't it? Our sources stress this drives margin expansion.
Absolutely. If they can push price increases that are slightly higher than their underlying cost inflation year after year, that difference drops straight to the bottom line. It creates predictable, almost structural margin growth over the life of these long contracts. It's a powerful financial engine.
Okay, so we've got what they do, the vertically integrated model, the different revenue streams. Now let's dig into the why they win the competitive advantage. You mentioned the industry structure. It's an oligopoly.
Yeah, it's this weird mix. At the very top, it's incredibly concentrated.
Yeah.
You've got the big three public companies, Waste Management, WM, Republic Services, RSG, and Waste Connections, WCN. They dominate.
But below them?
Below them, it's super fragmented. Hundreds, maybe thousands of smaller private haulers and municipal operations. But the key is the structural barriers in this industry basically prevent those smaller guys from ever really challenging the scale and integration of the big three.
And the biggest, most critical barrier, the one everyone points to, is the landfill, the irreplaceable asset, as the sources called it.
This is absolutely the heart of the moat. It's the piece of infrastructure that's almost impossible to replicate today, and it dictates so much of the industry's economics. The data is just staggering.
Go on.
Okay, back in, say, 1988, the U.S. had something like 8,000 permitted landfills. Fast forward to around 2014, that number had plummeted to roughly 1,500.
Wow. 8,000 down to 1,500. That's an incredible drop. Why? Where did they all go?
It's a perfect storm, really, of two massive forces: regulation and public opposition. First, regulations got way, way stricter. Think EPA rules under RCRA subtitled D-liners, leachate collection systems, groundwater monitoring, gas collection, mandatory post-closure care for 30 years.
So building and operating a landfill became vastly more complex and expensive.
Immensely so. Getting a permit for a new landfill today is a multi-year, multi-million-dollar nightmare. The engineering studies, the environmental impact statements, the public hearings, the capital required upfront is enormous.
And then you layer on the public opposition, NIMBism, not in my backyard.
Fierce NIMBism. Nobody, but nobody, wants a new landfill anywhere near them. Even if a company navigates the incredibly complex federal and state regulatory maze, local political opposition can often kill a project dead in its tracks.
So stringent regulations plus powerful local veto power basically freezes new supply.
Pretty much. It creates this incredible scarcity. If you're one of the companies that owns one of those existing permitted 1,500 or so landfill sites, you own an asset that is becoming more valuable literally every day because replacement is almost impossible.
Okay, now connect that scarcity back to the vertical integration we talked about. Explain this tolling mechanism that the sources mentioned. How does landfill ownership give them power even over their competitors?
Right, this is where it gets really powerful economically. As we said, the big three, WM, RSG, WCN together control something close to 90% of the remaining permitted landfill airspace in North America.
90%, okay.
So imagine you're a smaller, independent garbage hauler. Maybe you win a collection contract in a town. Great, you pick up the trash. Now what? You don't own the landfill.
You have to take it somewhere. And the odds are overwhelming that the only option nearby is a landfill owned by WM, RSG, or WCN.
Exactly. You must drive your truck to their gate and pay their price, the tipping fee, to dispose of that waste.
So even if they didn't win the collection contract, the integrated player still makes money on every ton that gets collected in their territory because they own the disposal bottleneck.
Precisely. They essentially get to toll almost every ton of waste generated, whether they collected it themselves or their competitor did. It's like owning the only bridge into Manhattan. Everyone crossing has to pay your toll, even the competing taxi companies.
That's a fantastic analogy. The landfill is the ultimate toll booth. It guarantees a revenue stream and reinforces the dominance of the integrated players.
It's a structural advantage baked into the very physics and politics of waste disposal. It ensures long-term profitability that's incredibly difficult for anyone else to challenge.
And beyond just the landfills, the sheer weight of regulations and the capital needed act as additional barriers, right? They're related but distinct.
Yeah, they work together. The regulatory burden isn't just about landfills. It covers collection safety, truck emissions, driver qualifications, waste tracking, recycling mandates, post-closure care. It's this incredibly complex web across federal, state, and local levels.
Too much for a small operator to handle efficiently.
Very difficult.
Yeah.
The big players have dedicated compliance teams, lawyers, engineers. They can spread those overhead costs across a massive revenue base. For a small hauler, just keeping up with the paperwork and the changing rules can be a huge drain. It naturally favors scale.
And the capital intensity, we're not just talking landfill development here.
Now, you need fleets of specialized, expensive trucks, collection trucks, transfer trucks. You need transfer stations, recycling facilities, maintenance depots. The ongoing capital expenditure just to maintain the fleet, stay compliant, and replace aging assets is enormous.
So you can't just, rent a couple of trucks and decide to compete with Republic services in a major city.
Not realistically. To build a vertically integrated network that can compete on cost and service in a significant market requires billions in upfront and ongoing investment. Land, permits, facilities, rolling stock. That financial barrier is massive and really cements the oligopoly structure we see.
Okay, so the moat is built on that scarcity, regulation, and capital intensity. Now let's look at the engine inside the castle, the financials. Our sources were really clear that earnings growth here isn't really about collecting more trash. It's driven overwhelmingly by pricing.
This is probably the single most important thing to understand about investing in this sector. They do not need GDP growth. They don't need population growth, driving huge volume increases to grow their earnings. They rely almost entirely on their structural ability to raise prices.
The numbers back that up strongly, right?
Absolutely.
Okay.
Look at their 2024 results. Total revenue was up 7.1%. Okay, decent growth. But get this, 6.5% of that 7.1% came directly from what they call core price increases.
Wow. So almost all the growth came from just charging more per unit, not from handling more units.
Exactly. It's incredible leverage, and it's so ingrained, even the municipal side, which you'd think is the most price sensitive due to contracts. Even there, they pushed through a 4.6% core price increase in the first quarter of 2025.
How do they manage that even with long-term contract
Right.
renegotiations, built-in escalators?
Both. Those annual escalators we talked about are key. But also, as contracts come up for renewal, you can bet they're pushing for pricing that reflects the current market reality, the value of their scarce landfill assets, the rising costs of environmental compliance, etc. They have shown remarkable discipline in pushing price consistently above their own cost inflation.
And this pricing power is absolutely crucial because looking at the numbers, they are facing some volume headwinds, aren't they?
They are. Total volume was actually down 1.1% in 2024 and down again 1.2% in Q1 2025.
Why the decline? And why does management seem relatively unfazed by it?
Well, the decline primarily reflects softness in those cyclical parts of the business we discussed, particularly construction and demolition waste, maybe some manufacturing slowdowns. But that's the economic sensitivity showing up.
Okay, but why aren't they panicked about losing volume?
Because their strategy isn't volume maximization, it's margin maximization. They've been very clear they are willing to intentionally shed lower margin or unprofitable contracts. They'd rather collect slightly less trash if it means every ton they do collect is significantly more profitable.
So it's a trade-off. Prioritize profit per unit over total units.
Absolutely. And you see the results directly in their margins. Because their price increases are consistently outpacing their cost inflation, even with rising labor and fuel costs, that operating leverage really shines. Their adjusted EBITDA margin expanded by a healthy 140 basis points in 2024, reaching 31.1%.
And continued improving into 2025.
Yep, hit 32.1% in Q2 2025. That widening gap between the price they charge and the cost to serve, that's pure profit leverage flowing through.
And that drove strong bottom line growth, net income up significantly.
Very strong. Net income grew 18.6% in 2024, reaching over $2 billion, $2.04 billion.
Yeah. Okay, now this leads to something interesting our sources highlighted. The divergence between net income and cash flow. Cash from operations was way higher than net income in 2024, like $3.94 billion versus $2.04 billion. Why is that gap so big, and why is it actually a positive sign for investors?
Ah, yes, the classic cash flow divergence in capital-intensive industries. It comes down to non-cash charges, primarily depreciation and amortization, or D&A.
Explain that simply.
Okay, RSG owns billions of dollars worth of assets, trucks, landfills, buildings, processing equipment. Accounting rules require them to gradually expense the cost of these assets over their useful lives. That expense is called depreciation or amortization.
And it reduces their reported net income on the income statement.
Correct. D&A is a huge expense line for RSG, but it's the key. It's a non-cash expense. They aren't actually writing a check for depreciation each year. It's just an accounting entry reflecting the assets getting older.
So the real cash generated by the business cash from operations isn't reduced by D&A.
Exactly. To get cash from operations, you start with net income and add back non-cash charges like D&A. Since D&A is so large for RSG, their cash from operations is consistently and significantly higher than their net income.
Meaning the accounting profit actually understates the true cash-generating power of the business. That's why free cash flow, FCF, is the metric everyone focuses on here.
It is absolutely the critical metric. FCF is basically the cash left over after they've paid all their operating expenses and made the necessary capital investments to maintain and grow the business. RSG generated a very healthy $2.18 billion in adjusted free cash flow in 2024. That's the cash available for acquisitions, dividends, buybacks.
But we have to remember that FCF number is after substantial capital expenditures, right? This isn't a business that can just stop investing.
Oh, absolutely not. It remains highly capital intensive. Their trailing 12-month CapEx was around $1.80 billion. If you look at CapEx as a percentage of cash from operations, it's roughly 46%. That's a big chunk of cash constantly going back into the ground, literally, or into new trucks and facilities just to sustain the operation and the mode.
So given that powerful, albeit CapEx-heavy FCF stream, how does management prioritize using that cash? What's the capital allocation strategy?
They seem quite disciplined. Looks like a clear priority stack. First dibs go to high-return internal growth projects. Think about those strategic initiatives. We'll discuss more of the renewable natural gas plants, the polymer centers. They're using FCF to build the next iteration of the business, focusing on sustainability and higher returns.
Makes sense. What's priority number two?
Strategic acquisitions. They're actively looking to buy smaller companies, especially in the environmental solutions space, to accelerate growth there. They've publicly targeted spending around $1 billion on acquisitions in 2025. It's their main external growth lever.
Okay, internal growth, external growth,
Mhm.
and then what's left comes back to shareholders.
Exactly. Shareholder returns are the third priority, but clearly a very important one for their investor base. They have an impressive dividend track record, increased it for 21 consecutive years.
That's serious consistency. Growing at a decent clip.
Yeah, typically growing the payout around 7% to 8% annually, which is quite healthy. And they supplement that with share buybacks. In 2024, the total cash returned via dividends and buybacks was about $1.18 billion. That consistent return of capital is a direct result of that strong, reliable FCF generation.
Right. So we've established the core business as this incredibly defensible cash-generating machine built on scarcity and pricing power. But now let's really dive into that strategic pivot you mentioned. They're actively using that cash flow and scale to recenter the business around sustainability. Is this just marketing, or is it fundamentally changing the business?
Oh, it seems much more than marketing. This looks like a genuine effort to transform waste streams, which used to be just liabilities, into valuable, often higher margin products and services. The U.S. Ecology acquisition in 2022 was really the foundational move here.
Right, bringing in that hazardous and industrial waste expertise.
Exactly. It immediately propelled them into that higher growth, more specialized market. It wasn't just about getting bigger. It was about getting into businesses with different characteristics, often requiring unique permits and technical know-how, which naturally means higher barriers to entry and potentially better pricing.
And the follow-on acquisition in 2025, Shamrock Environmental, focusing on industrial waste and wastewater treatment, that reinforces this isn't a one-off move.
Precisely. It signals this is an ongoing core part of their strategy. They are systematically buying their way into these complex environmental solutions niches. It's often faster and less risky to acquire existing expertise, permits, and customer relationships than trying to build them organically from scratch in these regulated fields.
Okay, let's get specific on two major internal investment initiatives driving this pivot. First, those polymer centers again. Creating a circular economy for plastics, how does that work financially?
So as we touched on, this is about dramatically moving up the value chain. Instead of just sorting plastic, #1 from plastic, #2, and selling bales into a volatile commodity market.
They're becoming manufacturers of recycled plastic resin.
Right. Using advanced washing, sorting, like optical sorters, and processing technology in these new dedicated polymer centers, like the first one in Las Vegas, the second under construction in Indianapolis. They're producing high-purity rPET from bottles and RHDP or PP from jugs, tubs, etc.
And the key is that this output isn't just scrap. It's good enough to replace virgin plastic.
That's the goal. To produce a consistent, high-quality feedstock that major consumer packaged goods companies, think beverage makers, consumer products companies, can buy and use directly in their packaging to meet their own ambitious recycled content goals.
So the economics shift from volatile scrap prices to more stable, potentially premium pricing for a manufactured good that solves a customer's ESG problem.
Exactly. You're selling a solution, not just a commodity. Their initial goal for just these first two centers is to produce 175 million pounds of these resins annually. That's a significant volume. Showing the scale of their ambition here, it helps de-risk their recycling segment significantly.
Okay, that's plastics. The second major strategic push is turning landfill waste into energy. Renewable natural gas, or RNG. How does that work?
This one is really clever because it tackles a major environmental issue, methane emissions from landfills, and turns it into a potential profit center. Landfills naturally produce methane as organic waste decomposes anaerobically.
And methane is a potent greenhouse gas, right? Much worse than CO2 short term.
Exactly. Landfills were responsible for something like 15% of total U.S. methane emissions in 2020. So regulations increasingly require landfills to capture this gas anyway. RSG's strategy is to not just capture and flare it, burn it off, but to clean and upgrade it.
Upgrade it to what?
They process the raw landfill gas, removing impurities like CO2, water, sulfur compounds, until it meets the quality specifications for natural gas pipelines. It becomes chemically identical to fossil natural gas, but derived from a renewable source, decomposing waste, hence renewable natural gas, RNG.
And they're doing this through a joint venture with BP.
Yes, they partnered with BP for their expertise in gas processing and marketing. RSG provides the landfill gas feedstock from their sites, and together they build and operate these RNG plants.
So they sell the RNG commodity into the pipeline. Is that the main value driver?
Actually, often it's not. While they do get revenue from selling the physical gas, the really significant value, especially in certain markets, comes from the environmental attributes associated with that RNG.
Meaning?
Because it's a low-carbon fuel derived from waste, producing and using RNG generates valuable environmental credits. Think Renewable Identification Numbers, RINs, under the Federal Renewable Fuel Standard or Low Carbon Fuel Standard, LCFS credits, in states like California.
And these credits can be sold to companies that need to meet renewable fuel obligations.
Exactly. And in many cases, the value of these credits can actually exceed the commodity value of the gas itself. It creates a very attractive, high-margin revenue stream that's linked to environmental policy, not just natural gas prices.
So it's a double win, reducing emissions and creating a high-value product. They brought 6 projects online in 2024, 7 more planned for 2025. That's rapid deployment.
It really is. It represents a major capital investment aimed squarely at generating new, high-margin revenue streams from their existing landfill assets, essentially future-proofing them while improving their environmental footprint.
Beyond these big new platforms, are they still focused on just running the core trash business better, operational efficiency through tech?
Oh, absolutely. That's crucial for offsetting those persistent cost pressures from labor and fuel we talked about, through investing heavily in digitalization and automation. Think advanced routing software, using AI to optimize collection routes dynamically, reducing miles driven and fuel burned.
And technology inside the trucks, too.
Yeah, in-cab technology, providing real-time data to drivers and managers, monitoring truck performance, optimizing schedules, improving safety. Even seemingly small improvements, shaving a few minutes off dozens of routes every day across thousands of trucks, adds up to enormous savings in fuel, maintenance, and overtime costs. Continuous improvement in the core operation is vital for margin expansion.
And lastly, on the operational front, this ambitious goal for fleet electrification, aiming for 50% of new truck purchases to be electric by 2028. That sounds expensive upfront.
It is definitely ambitious, and yes, the upfront cost of heavy-duty electric collection trucks is currently significantly higher than traditional diesel trucks. It's a major capital commitment and carries some technology risk.
So what's the payback? Why do it?
The bet is on total cost of ownership over the long run. EVs are expected to have substantially lower operating costs. Electricity is generally cheaper and less volatile than diesel fuel, and maintenance should be much lower. No complex engines, transmissions, exhaust systems, fewer brake replacements due to regenerative braking.
So a near-term CapEx hit for a long-term OpEx saving, plus the obvious environmental benefits and potentially better relationships with climate-conscious municipalities.
That's the calculus. Lower operating costs, quieter operation, which communities appreciate, zero tailpipe emissions. It aligns with their sustainability strategy and could become a competitive advantage in securing contracts down the line, assuming the technology proves reliable and the charging infrastructure can be built out efficiently. It's a bold, industry-leading move.
Okay, let's place Republic Services back into that competitive landscape. We know it's an oligopoly, RSG, Waste Management, WM, Waste Connections, WCN. How do they stack up against each other strategically? How should listeners think about the differences?
Right, the big three. Waste Management, WM, is the undisputed giant. Largest player by revenue, largest landfill network, often the first mover on big technology plays like large-scale landfill gas energy. They have the most comprehensive national coverage. Think of them as the 800-pound gorilla.
Okay, then Waste Connections, WCN. You mentioned their strategy is different.
Very different, and it shows in their results. WCN deliberately focuses more on secondary or rural markets, often outside the major competitive battlegrounds of the big cities. They pursue a strategy of gaining exclusive franchise agreements in these less competitive markets.
So they trade maybe lower total market size for higher market share and less direct competition within their chosen territories.
Exactly. It's often described as more of a super-regional dominance strategy, rather than the coast-to-coast major metro focus of WM and RSG. They prioritize market structure over sheer market size.
And the financial outcome of that focus on exclusivity and lower competition.
It translates into consistently industry-leading profitability. WCN typically boasts the highest adjusted EBITDA margins in this sector. They hit around 32.5% in 2024, which is a bit ahead of RSG's 31.7% that year.
So WM is the biggest. WCN is arguably the most profitable on a margin basis due to market selection. Where does RSG fit?
RSG is the clear number 2 in scale, focusing on gaining leading market share in major and secondary metropolitan markets, leveraging that vertical integration we discussed. Their key differentiator recently, as we've explored, is the aggressive expansion into the environmental solutions segment via acquisitions like U.S. Ecology and Shamrock. That's their distinct growth vector right now.
How does this play out in valuation when you look at trading multiples, say EV to EBITDA?
You see those strategic differences reflected quite clearly. RSG tends to trade around, say, 16.4 times forward EBIT. That's typically a small premium to WM, which might be closer to 15.8x.
Why the premium to the bigger player, WM?
Potentially reflects RSG's slightly better execution on pricing and margins recently, and maybe excitement about the growth potential in environmental solutions. But then you look at WCN.
Much higher multiple.
Significantly higher. WCN often trades up around 21.5 by EBITDA, sometimes even higher. That substantial premium reflects the market rewarding their unique strategy. The focus on exclusive, less competitive markets, which delivers those superior margins and historically higher organic growth rates, albeit off a smaller base than WM or RSG.
So RSG's valuation sits in the middle, reflecting its large scale and stability like WM, but also its successful strategic pivots and solid execution, though not quite capturing the margin supremacy and perceived lower risk of WCN's exclusive market focus.
That's a good summary. It's a blend of scale, stability, and demonstrated growth initiatives.
Okay, let's talk risk. Even in a defensive business like this, things can go wrong. What are the key risks investors need to watch?
Number 1 is still cyclical exposure. We saw it impact volumes recently. While the residential base is stable, that industrial segment construction waste, manufacturing waste, is definitely tied to the economic cycle. A sharp or prolonged recession would hurt volumes and could, temporarily at least, limit their ability to push those aggressive price increases if customers are really struggling.
Makes sense. What's next?
The constant cost pressures. This is a logistics-heavy business. They are perpetually exposed to inflation in 3 key areas. Labor, especially finding and retaining qualified truck drivers. Fuel, diesel prices can swing wildly. And maintenance, steel costs for bins, truck parts, tires.
And while their pricing power has been a great shield,
It has, but a sudden, unexpected spike in one of those costs, imagine oil prices doubling overnight, could squeeze margins in the short term before contract escalators fully catch up. Labor availability and wage inflation in particular seem like a persistent challenge across the trucking and logistics industries.
okay, cyclicality, costs. What else? You mentioned their move into recycling and RNG. Does that bring new risks?
It does introduce more commodity volatility, at least potentially. While the polymer centers aim to de-risk plastics recycling, the traditional side still has exposure to paper, cardboard, and metals prices. And RNG, while often driven by environmental credits, still has a component linked to volatile natural gas prices.
But didn't you say they have a way to mitigate the recycling commodity risk?
Yes, and it's quite effective. They increasingly use sustainability recycling adjustment fees, or SRA fees, in their contracts.
How do those work?
Basically, it's a mechanism that passes the commodity price risk directly through to the customer. There's a baseline price assumption for recycled commodities. If actual market prices fall below the baseline, a fee is added to the customer's bill. If prices rise above the baseline, the customer might get a credit.
So RSG's margin on recycling is protected regardless of where commodity prices go.
Exactly. It shifts the volatility away from RSG and onto the customer, making their recycling financials much more stable and predictable. It's a smart contractual tool.
All right, final area, governance and management. The current CEO, John Vander Ark, seems well regarded for navigating the recent inflation and driving these strategic shifts. How is the company ensuring management stays focused on these long-term sustainability goals? Is compensation aligned?
Yes, they've put a specific mechanism in place. Executive compensation, the annual bonus part, includes what they call a sustainability modifier. It means the executive team's annual incentive payout can be adjusted up or down by as much as 10% based specifically on how well the company performs against preset sustainability targets.
What kind of targets?
Things related to safety performance, talent development and diversity, and importantly, climate goals, which could include progress on fleet electrification, rolling out those RNG projects, reducing their overall emissions footprint.
So hitting those ESG targets directly impacts executive paychecks.
Correct. It creates a very direct financial incentive for management to not just talk about sustainability, but to actually execute on those strategic environmental initiatives we've been discussing. It aligns shareholder interests with these longer-term strategic pivots.
So wrapping up the risk profile, despite the cyclical sensitivity and cost pressures, the overall picture is one of exceptional resilience.
I think that's fair. The risk of a complete collapse, a catastrophic loss, it's incredibly low here. You're dealing with an essential service, protected by immense regulatory and capital barriers to entry, operating within an oligopoly structure that grants significant pricing power. Combine that with the recurring revenue from long-term contracts and strong cash flow generation. It's a business model built to endure, even thrive, through most economic conditions.
So bringing it all together for the listener, we started this deep dive noting how waste management, often ignored, is actually one of the most profitable and defensible sectors. I think we've clearly seen why that is. It's not really about volume growth, is it?
Not primarily. The story's about structural pricing power. Power that comes directly from owning those scarce, irreplaceable landfill assets and operating within that protected oligopoly structure, providing an absolutely essential service under long-term contracts.
And the Republic Services story, specifically, is about taking the immense, reliable cash flow generated by that core moat and strategically deploying it into these future-focused, higher-margin environmental solutions, turning liabilities like landfill gas and plastic waste into valuable assets like RNG and recycled resins.
Exactly. It's a case study in leveraging an existing competitive advantage to fund and build the next generation of the business, aligned with broader sustainability trends.
Okay, so here's the final provocative thought for you, the listener, to chew on. We've just explored how companies like Republic Services are essentially engineering solutions to our waste problems, turning landfill gas into energy, plastic scrap into usable materials. Given the perpetual scarcity of places to put waste, the ever-increasing regulatory hurdles, and the absolutely guaranteed nature of the service, could it be that owning the infrastructure that solves society's waste problem is actually the ultimate form of future-proof, ESG-aligned infrastructure investment? Something to maybe think about next time you wheel your bin to the curb.